Okay, welcome sir to the video presentations of Introduction to Financial Management. Before running this particular presentation, sir, I like to request you to take your handouts and that will help you to understand sir, the subject matters quite clearly. Okay, the first of all, sir, we need to identify sir, what are the areas we are going to discuss through these presentations. Go to the next slides, and next slide will explain to you what are the areas we are going to discuss. And at the end of this presentation, so you will be able to understand what is financial management, financial resources, the scope of financial management, relationship of financial management, financial functions, roles of financial manager, objective of financial management, weaknesses of profit maximization, agency relationships, agency problems, and agency cost. Okay, move to the next slides, and this slide will explain to you what is financial management. What is financial management, right? According to the given information here, financial management is managerial activity, right? Managerial activity, which is considered on planning and controlling of firms' financial resources, right? Firms' financial resources. If you are going to planning and controlling financial resources of a firm, that is what we call financial management, or activities related to planning and controlling of financial resources of a business organization is called as financial management. Again, what is financial management? Activities related to planning and controlling of financial resources of a business organization is called, or is a term as, financial management. Now you have kind of the understanding what is financial management. Again, recall it. What is financial management? Financial management is activities related to planning and controlling of financial resources of a business organization. Financial resources of a business organization. Okay. Now we have a special term called financial resources. If we need to identify what is financial management, we need to know what are these financial resources. What are these financial resources? In coming slide, we can understand what is this financial resource, or what are the financial resources available in the business organizations. Okay, move to the next slides to identify what are the type of the assets available in the business organization according to the financial management. According to the financial management, asset being classified into three different ways, or three different groups. Right, look at what are the assets that we are going to identify under the financial management. The first part is tangible real assets. Second part is intangible real assets. Third part is financial assets. This is one of the important things we need to identify in the financial management, because financial management talk about planning and controlling these financial assets or financial resources. Therefore, it is very important to identify what is the meaning of financial assets. In the next slides, you can identify what is the exact meaning of these financial assets. Before that, we need to identify, or we need to get kind of the understanding what is these tangible real assets and what is these intangible real assets, and where we can see these tangible and intangible real assets. Okay, my dear students, if you can remember statements of financial position, especially the items available under property, plant, and equipments of a statements of financial position, right? The items that we are going to list out under property, plant, and equipments of statements of financial positions can be called as tangible real assets. Tangible real assets. There are so many items that you can identify in a statements of financial position under property, plant, and equipment. All those items can be called as tangible real assets. So what are the items that we can identify under the property, plant, and equipments? Those are land and building, plant and machinery, and motor vehicles, compute equipment. So these type of items that you can identify under property, plant, and equipment, those can be called as tangible real assets. Those can be called as tangible real assets. So in other words, we can say these are the examples for tangible real assets. And also we have intangible real assets. This one also can be seen from our statements of financial position. Statements of financial position under the asset side, we can see rather intangible real assets also, right? What are the examples that we can give? We can say goodwill, that is not available here, and technical know-how, technical collaborations, trademarks, and also the copyrights, and we can say patent right. These are the examples that we can give for intangible real assets. Both these tangible real assets and intangible real assets can be seen in a statements of financial position, under asset side, What is the difference between these tangible real assets and intangible real assets? I believe that you can understand it. What is the difference, or how we can differentiate these tangible real assets and also intangible real assets? Tangible real asset is concerned, it has physical substance. Tangible real asset means it has physical substance. If it is intangible real assets, physical substance cannot be seen. Or in very simple way, we can say, if it is tangible real asset, it can be touched. If it is intangible real assets, it cannot be touched. That's the main difference between these tangible real assets and the intangible real assets. We should not change. Where we can see these financial assets. Okay, move to the next slide. Then we can identify what is these financial assets. Okay, my dear students, go to the next slides and try to understand what is the exact meaning of these financial resources or financial. This slide will explain what is financial resources, or in other words, we can say that is financial assets, financial resources or financial assets. Under these ones, we can identify two different items. What are the items that we can identify under the financial assets and the financial assets or financial resources? The financial instruments and also the financial contract. Financial instruments and also the financial contract. If you are going to use these financial instruments and financial contract to collect the fund, that is what we call financial resources. Okay, look it again. Financial resources are the financial instruments and financial contract that used by the firms to collect funds. Therefore, under this financial resource, we can identify two different items. What are the items that we can identify under the financial resource, financial instruments, and the financial contract? Okay, why we use these financial instruments? Why we use this financial contract? The purpose of using these financial instruments or financial contract to collect the funds. Therefore, what is financial resource? Financial resource is a financial instruments or financial contract that business firms use to collect the funds. Therefore, you have kind of the idea what is this financial resource now. What is this financial resource? Okay, my dear students, so what are the examples that we can identify for financial instruments? The few examples being given here: shares, debentures, and commercial papers. In addition, another financial instruments can be seen. And also, what are the financial contract? Bank loan and the financial lease. These are the common financial contract that we can see in the business organizations. What are the examples for financial instruments? Shares, debentures, and the commercial papers. What are the examples that we can identify under the, what are the items that we can identify under the financial contract, bank loan, and the financial lease agreements? In addition, another financial contract can also be seen, where we can see these financial instruments and the financial contract. That also can be seen from statements of financial positions of a business organization, right? Financial instruments and also the financial contract can be seen from statements of financial position, But these financial instruments and financial contract can be seen in the liability side of a statements of financial positions. Okay, can you go to the previous slide, right? Look at previous slide. In previous slides, my dear students, it's classified resources available in the business organization into three different parts. The first one is tangible real assets. The second one is intangible real assets. These two items can be seen in the statements of financial positions under the asset side. But financial assets, now we know that. So what is the meaning of financial assets? Now we know what is the meaning of financial assets. These financial assets can be seen in the liability side of statements of financial position. Therefore, in financial management, both asset sides and liability sides being considered to identified assets of the business organizations, right? What we can say in financial management, both what you call asset sides of the statements of financial positions and liability side of a statements of financial position, been considered to classify the resources available in the business organizations. What we can say in the financials management, it's considered about both asset sides and the liability sides of the business organization to identify resources available in the business organization. Right? In the asset sides, we have real tangible and real intangible assets according to the financial management. In liability side, we have financial assets. The financial assets being used by the business organizations to collect the funds. Under these financial assets, we have two different items. What are the items that we have? Financial instruments and also the financial contract. Right? Go to the next slide. It's talk about this financial resource. We have already talked about this one. Can you remember what is financial resources or financial assets? Financial resources and financial assets means financial instruments or financial contract that we use to collect the funds for the business operations, right? Can you recall what is financial management? Financial management are the activities. Financial management are the activities which is related to controlling and rather planning and controlling of financial resources. Can you remember what is can you recall what is financial management? Financial management is activity which is related to planning and controlling of financial resources of a business organization. What is financial resource? Financial resource means financial instruments or financial contract which business organization use to collect funds. Okay. Go to the next slide. Next slide explain what is the scope of financial management. What is the scope of financial management? These two areas or these two tasks fall into the scope of financial management. What are the things available in the scope of financial management? Collections of funds or collecting funds and also allocating funds. These two items fall into the scope of financial management. Both these items fall into the scope of financial management. What are the items? Collecting funds and also allocating funds. Okay, read this one. Providing, so collecting financial resources and allocating them in efficient and effective manner to run business operations are fall into the scope of financial management. Therefore, there are two different items or two different areas that we can identify in the scope of financial management. So what are the areas that we can identify in the scope of financial management? Collections of funds for the business operations and allocating funds for the projects. That is what we can see in the scope of financial management. Okay, move to the next slides and look what we have. My dear students, in these slides, we are going to talk about the relationship of financial management. Okay, look at it. Financial management has interconnected with all part of business organizations such as manufacturing, administration, and human resource. Right? In these diagrams, explain financial department has a link with the production department, financial department has a link with marketing department, financial department has a link with human resource department, financial management department has a link with administration department. Can you identify this one? Right? Look at here. Production department produce new production plan. Right? Production department produce new production plan. To implement these production plans, production departments need to have resources, but resources being provided by the financial department. Unless financial departments provide resources to production department to implement a new production plan cannot be implemented. New production plan cannot be implemented unless production department can get the required resources from the financial department. That new production plan cannot be implemented. If we need to get the resources from the financial department, first the production department need to get the approval from the financial department, then only production department can get the resources from the financial department. Therefore, you can identify that there is interconnections between the production department and also the financial departments. And when we are going to talk about this marketing department, suppose marketing departments designs a new promotional campaigns for the coming financial year, right? They plans a new promotional campaigns for the coming financial year. But to implement this, to work out this particular promotional campaign, marketing department requires resources, right? resources being given by the financial department. Unless marketing department has kind of the good relationships with the financial department, marketing departments can't get the resources from the financial department and implement their new promotional campaign or work out their new promotional campaigns. Therefore, marketing department should have kind of the close discussions with the financial departments related to the new marketing programs or new promotional programs. Then only marketing department can get the resources from the financial departments and work out their marketing plan in practical manner, right? And when we are going to look at the human resource department identifies so many vacancies for the business organizations, right? Human resource departments plans to recruit people for the vacancies that they have identified. But without getting help from the financial department, new recruitments cannot be done by the human resource department, because if we have new recruitments, we have to pay salaries and also the other benefits package. For that, we need to get the resources from the financial department. Unless financial department in the positions to provide the required resources for the human resource department not in a position to build the vacancies available. Human resource department should have very smooth discussion with the financial departments before taking the recruitment decisions, right? Before taking recruitment decision. Administration departments also same. Administration department decides we need to hire new security firms for the business organization. But without getting help or without getting approval from the financial department, that cannot be hired, or new security firms cannot be hired, because to hire in the security firms, resources being provided by the financial department. Therefore, before taking real decisions related to the hiring of new security firms, a business administration department should have very close relationship or very close discussions with the financial department. Then only we can hire new security firms. Otherwise, it cannot be done. Okay. With these explanations, my dear students, you can identify the financial department has a direct link with all other departments of the business organization. That is why we say financial department has interconnected with all part of the business organizations. Okay, go to the next slides and identifies what we have. Financial functions. Under long-term financial functions, we can identify 3 different functions. Under short-term functions, we can identify just only 1 functions. These functions can be called as financial decision also. Therefore, under long-term financial functions, we can identify 3 different functions or 3 different decisions. Under short-term financial functions, we can identify 1 function or 1 decisions. Okay. Identify what are the long-term functions available. Raising funds or collecting funds. Investments in assets, or we can say allocating funds. Distributions return to the shareholders, or we can say, in other words, financial decisions, investment decision, and dividend decision. Under the short-term financial functions, we have balance cash inflows and balance cash outflows, and this one can be called as liquidity decision. Okay. In the previous slides, we have identified financial functions. We have 4 different financial functions or financial decisions according to the previous slides. Okay, my dear students, first thing, we need to identify what are the long-term financial functions available here. The first long-term financial functions are raising funds. Second one is investments in assets, and third one is distribution returns to the shareholders. Okay, take first one, and first one's a bit in details. Okay, raising funds. So that how financial manager collect a fund. For that, what is the device that financial manager can use? Again, financial manager can use financial assets to collect the funds. The financial assets are being consisted of 2 different options. The first one is financial instrument. Second one is financial contract. That we have also already recognized when you're going to talk about the financial assets in the previous slides. Okay, my dear students, when financial manager going to take the decision related to these collections of funds or the financial decision, the financial manager has to take into considerations a few different factors or few different matters. What are the matters or what are the factors that financial manager should take into considerations, that is from where financial manager can collect the funds for the business operations, or from which sources financial manager can collect the funds for the business operations, right? There are so many sources available under the financial instruments and also the financial contract. Under financial instruments, we have ordinary shares, we have preference shares, we have preference shares. Preference shares is concerned that there are so many varieties of preference shares available. In addition, we have under the debentures and also the commercial papers. Those can be seen under the financial instruments. Those are the sources of fund. And also under the financial contract, we have very common and popular two contract. That is, one of the things is a bank loan, and another one is financial lease agreements. By using these sources, financial manager can collect the funds, right? By using these sources, financial manager collect the funds. And therefore, when financial manager going to take the decision related to the collecting the funds for the business operation, financial manager first identified or take into consideration from which sources financial manager should collect the funds, right? From which sources financial manager is going to collect the funds for the business operations. The second one is how much should be collected from each and every sources, because there are so many options available to collect the funds for the business organization. Therefore, we need to decide from each and every sources how much we can collect, or how much we should collect for the business operation. How much we should collect for the business operation. That should be decided by the financial manager. If we can collect the funds from single source, we do not have any kind of problems, because we can collect the funds from single sources. But if we need to collect huge amount of funds, sometimes it's not possible to collect the funds in the single sources. Then we need to think about combination of sources. If we are thinking about combination of sources, we have to decide how much that we need to collect from each and every sources. We have to decide it, right? Not only that, but also financial manager has to think about cost of these collections, or cost of each and every sources of fund, right? Therefore, when financial manager is going to take this financial decision, he should think about from which sources financial manager should collect the funds, and from each and every sources how much he should collect for the business operations. And then he need to think about, or financial manager need to think about, what is the cost of this each and every sources of fund. All those things has to be taken into considerations when financial manager going to take the financial decisions. When financial manager going to take these allocating decisions, financial manager need to select the project which generates higher returns. And also these returns should more than the cost of capitals or cost of funds. Otherwise, it's a loss for the business organization. Therefore, when financial manager is going to take the investment decision, financial manager first thinks about the project which generates higher returns for the business organizations. Then he need to think about what is the cost of the funds. The return always should be greater than the cost of the funds. Otherwise, it's a loss for the organizations. Therefore, when financial manager is going to take investments decision, he should think about the projects which generates higher returns. This return should be greater than the cost of capital. So the cost of the funds, right? These two factors has to be considered when financial manager is going to take this investments decision. What are the factors he need to consider? The first thing, project generates higher return, and also the cost of the collections, or cost of the funds. And project manager should ensure that investments are being done in the project which generates more returns than the cost of the funds, right? Then look at distributions of returns. So you know that when we are going to invest, we have returns. So part of this returns should be given to the shareholders, because the shareholders is the owners of the business organizations. Therefore, they need to have kind of the returns for their investments. So therefore, when we are going to take the decisions, when financial manager going to take the decisions regarding distribution of returns, he need to think about, or he need to decide how much of returns should be kept with the business organizations, with the idea of reinvesting. That is what we call retentions, that is what we call retentions. And also we need to decide that how much of dividend should be distributed among the shareholders. That is what we call payout. That is what we call payout or dividend payout, right? These two factors has to be considered when we are going to distribute the dividend for the shareholders. What are the factors we need to consider about? The how much we have to keep with the business organizations with the idea of reinvestments, and also how much of returns should be distributed among the shareholders. Those are the long-term financial functions. Long-term financial function that has to perform, so that has to made by the financial manager. Okay, recap again. What are the long-term financial functions or long-term financial decisions? We can say collecting funds or financial decisions, allocating fund or investment decisions, distributing returns to the shareholders, or we can say dividend decisions. Okay. Now go to the next slides and identify what are the short-term financial functions that has to be performed by the financial manager. Okay, go there. Look at it. Short-term financial functions, we have just only the single short-term financial functions. That is balance cash inflows and the balance cash outflows. That is what we call liquidity decisions. Okay, read what we have here. The firms has to keep a part of its resources to maintain the liquidity. Otherwise, it seriously hurts the firms, and ultimately the firms become insolvent. But keeping excessive current assets more than the requirement restricts the ability of the firms to earn long-term profit. Therefore, it is important to trade off between profitability and liquidity. What this means? Okay, you know that we have collected funds, right? These funds should be invested in long-term assets and also the short-term assets. If you are going to keep only long-term assets, we have a problems related to the liquidity. Therefore, to maintain enough liquidity, we have to keep some part of the resources in the current assets. Current assets can be converted into the cash, or current assets can be used for the purpose of liquidity. But if you are going to keep each and every funds in the current assets, what it happened, we do not have long-term assets, which means that we are not in a position to earn long-term return, right? Therefore, we need to decide how much of resources should be kept in the current assets and how much of resources should be kept as a long-term assets, because unless we have current assets, what happen? We have to face liquidity problems. If you have liquidity problems over a longer period of time, definitely our business organization become bankrupt or it's become insolvent. At the end of the day, we have to close the business organizations due to these liquidity problems. If you have liquidity problems a longer period of time, definitely our business organization has to be closed down. So therefore, the portions of the assets should be maintained as a current assets, with the idea of keeping a strong liquidity. For the business organizations, right? In addition, part of the assets should be invested. Part of the resources should be invested in the long-term assets also. Unless we have long-term assets, we are not in a position to generate long-term profit for the business organizations. Therefore, we need to think about how much of assets should be kept in the business organization as a current assets, and how much of assets should be kept in the business organization as a long-term assets. This is actually balancing the options between liquidity and also the profitability. Under the short-term financial functions, therefore, financial manager has to balance this liquidity of the business organization and also the profit of the business organization. It's a part of the duties of financial manager. Okay, move to the next slides and identify what we have. Look at what are the roles of financial manager, or what are the tasks that financial manager has to perform within the business organizations. These kind of items also derives from, as I said earlier, from the financial functions. Okay, look at what are the roles of financial manager. Raising funds or collecting funds, that is one of the roles that financial manager has to perform. And investing funds, that is again another a task that a financial manager has to play within the business organizations. And managing the funds, you know that when we are going to invest the funds, the particular projects will generate the funds. These funds should be managed by the financial manager. That is also part of his role. And distributing returns. Distributing returns, when we are going to invest funds in the projects generates returns. This return should be distributed among the owners of the business organization. Therefore, distributing returns is also another task of the financial manager to play in the business organizations. And the total returns that we have generated from the investments is not going to be distributed among the shareholders. Instead, we are going to keep some portions within the business organizations as a retentions or retained earnings. These retained earnings should be reinvested in the projects which generates higher profit. That is also part of the duty has to perform by financial manager. Okay, go to the next slides and try to understand what are the objectives of financial management. Actually speaking, so this is a very interesting area in the financial management. In the financial management, objectives can be identified according to two different approaches, right? First approach is economic approach. Second approach is accounting approach. Under the economic approach, wealth maximizations of the firms is the main objective of financial management. So under the accounting approach, profit maximization is the main objective of financial management. But for this accounting approach, there are so many weaknesses. Therefore, this wealth maximization is treated as an objective of financial management. Okay, we can go to the next slide. So then we can talk about this wealth maximization, profit maximizations in details. In addition, we can identify what are the limitations or what are the weaknesses of these profit maximizations objectives. Okay, go to the next slides and then we can talk about what are the objectives of financial management. Right. Look at here. As per the economic approach, wealth maximizations of the firms is the main objective of the financial management. Right? What is the main objective of financial management according to the economic approach? That is wealth maximization. Right? What is wealth actually? Wealth is the market concept, right? Wealth is a market concept. How we can collect the wealth of the business organizations, the number of shares available in the business organization multiplied by market price per share. That is how we can calculate the wealth of the firm. Right? Look at it. Wealth of the firms is represented by market value per share. Right? Wealth can be calculated like this. Wealth of the firms is equal to number of shares into market value per share. Right? Market value per share. Again, what is the main objective of financial management according to the economic approach? That is wealth maximization. Right? Go to the next slide. So then identified what is this profit maximizations. According to the arguments of the profit maximizations, they say if a business organization can earn more and more profit, the profit more profit can be distributed to the shareholders. So that wealth of the organization or wealth of the shareholders can be increased. That is their arguments. But this profit maximization objective has kind of the limitations or the weaknesses. Therefore, we are not going to accept this profit maximization objectives as the main objective of financial management. So, okay, look at what are the limitations or what are the weaknesses that we can identify related to accounting approach or the profit maximization objective. It's been talked as wealth maximization versus profit maximization. So, okay, look at it. As following weaknesses associated with accounting profit, wealth maximization gain much interest among scholars as main objective of financial management. We take wealth maximizations as the main objective of financial management. Weaknesses that has happens due to the few weaknesses associated with the accounting profit. Okay, look at what are the weaknesses associated with the accounting profit. Okay, weaknesses of accounting profit. Because of these weaknesses, we are not going to take this profit maximization as a main objective of financial management. Instead, we are going to take this wealth maximization as the main objective of financial management because we have some weaknesses in accounting profit. Okay, look at what are the weaknesses that we can identify in accounting profit. There is no specific meaning for accounting profit. Yes, it's okay. When you are going to see your statements of incomes, there are so many concepts available as a profit. Gross profit is there. The profit before tax is there, right? And profit after tax is there. Profit from continued operation is there. Profit from non-continued operation is there, right? Operating profit is there. There are so many concepts available. So therefore, when we are going to talk about profit, we don't know regarding which profit we are going to discuss or regarding which profit we are going to talk about, right? Time value of money is not considered. Yes, it's okay. If we have huge amount of credit sales during the current financial year, definitely we have huge amount of profit, But when we are going to identify this profit, we are not considering about whether we have collect the funds related to these sales, right? Related to these sales. Actually speaking, so we did not consider about it, no? When we are going to calculate the accounting profit. That is why we are saying time value of money is not considered here. And also risk associated with the return is not considered. It's okay that we have calculated the profits due to the credit sales. Due to credit sales, we have identified huge amount of profit. But we have a risk. Right? But we collect the collection from our debtors, right? Or account receivables. We don't know whether account receivables realize or not in the next financial year. We have a risk, but still we are going to recognize the profit. That is why we say here, risk is not considered, right? Risk is not considered. Time value of money is not considered. In addition, there is no specific meaning for the accounting profits. What are the weaknesses of accounting profit? There is no specific meaning for accounting profit. Time value of money is not considered. Risk associated with the return is also not considered. Okay, go to the next slides and then you can identify what is the agency relationships. Okay, without looking at informations available here, my dear student, I will ask you, who are the owners of the company? That is the shareholders, right? But day-to-day operations of the business organizations or the company being handled by shareholders or team of management. That is team of management, which means that team of management performs the operations of the business organizations on behalf of the shareholders, right? Who are the owners? Shareholders is owners, but the operations of the business organization being handled by the team of the management appointed by the shareholders. Therefore, the team of the management performs these operations on behalf of the shareholders. Shareholders, in this sense, we can say principals, and team of management can be identified as agent, right? Owners can be identified as principals of the business organizations, and also team of management can be identified as agent, right? Here, agency relationships can be seen because the principal assigns some task to the agents to perform on behalf of them. Then agents perform the task on behalf of the principals. These relationships can be seen within the business organization. Therefore, that particular relationships can be identified as agency relationships, right? In these agency relationships, what has happened? Decision-making authority being given to the team of the management by the shareholders, right? In this case, decision-making authority being given to the team of the management by the shareholders, Or we can say, in other words, decision-making authority being given or assigned to the agents by the principals. Who are the principals here and who are the shareholders? Who are the agents here? Team of the management. So therefore, these relationships can be seen in the business organization. The most probably in each and every business organizations, we can see this one. The owner is there, but the owner not involved for the day-to-day operations, right? The day-to-day operations being handled by the team of the management, which is hired by the principals or the shareholders or the owners of the business organization. These relationships can be called as agency relationships. Okay, go to next. Okay, my dear students, and now go to the next slides and look what we have in the next slide. In the next slides, we have kind of the problem. These problems are related to these agency relationships. Look what the problems we have due to these agency relationships. That is what you call agency problem, right? Look what we have here. Inefficiencies that arise in agency relationships are called as agency problem. Agency problems occurs when manager maximize their own welfare or benefits packages instead that of the principals, right? We talk about in agency relationships, principal is there, shareholders is there, and also the team of management is there. But the interest or the objectives of these two different parties is concerned, they have two different contrast objectives, right? They have two different objectives or contrast objectives. Shareholders is concerned, they need to maximize the wealth of the business organizations. Managements or team of the managements need to increase their one benefits. They need to have better salary, right? They need to have pre-transport facilities. They need to have pre-accommodation facilities. And in addition, they need to have foreign trips. There are so many objectives that management or the team of management has. But it's not in line with the objectives of shareholders. Shareholders need to increase the wealth of the business organizations, and managements need to increase the package of the benefits that they have from the business organization. Therefore, from the objectives is concerned, from the interest of these two parties is concerned, it's not going in the same directions. It's going in the two different directions, right? Two different directions. Therefore, conflict can be identified related to the objectives of shareholders or the principals, and also the objectives of agents or the team of the management. This conflict between the objectives of shareholders and the team of the management can be identified as agency problem. What is agency problem? Conflict between objectives of shareholders and objectives of team of management can be identified as agency problem. When the business organizations, when we are going to run the business operations, we have this conflict, but we need to somehow manage this conflict. Problems can be minimized up to some extent, right? Or can be reduced up to some extent. How we can minimize this one? For that, we have to incur some cost. That is what we call cost of agency problem, right? What are the costs that we need to incur to minimize this agency problems? First things, we need to give sufficient benefit package for the people, right? If we hire some people work on behalf of us, we have a responsibility to give right benefit package for them. Otherwise, expected service from them cannot be taken, right? Not only given the benefit package, but also we have to monitor the activities performed by them. Because we don't know that after taking the right benefit package, whether they are working on behalf of us. We need to monitor their activities, whether they are working in line with our objectives. So for that, we have to incur some expenses for the management audit. If you are going to give the right benefit package, and also if you make expenses for the management audit, from that you can reduce this agency problem. Reduce these agency problems up to some extent. It cannot be eradicated up to the zero levels, but these agency problems can be minimized up to the satisfactory level, having given sufficient benefit package to the management, and also having monitored activities performed by the management through the management audit. Okay, with this I'm going to conclude this presentations related to the introductions part of financial management. And you have so many review questions in your handouts, so you need to attend all review questions. And if you have any kind of queries and problems or any gray areas related to this introduction part, you can contact me during the time allocated for you in your timetable, and or whenever you need, you can contact me, no problem at all about it. And I will conclude this presentations with the idea of meeting these kind of presentations again. Okay, thank you very much. Thank you very much, all of you.